Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for November 28th of 2022. Disclaimer for important information. Well, I certainly hope everyone had a wonderful Thanksgiving week, enjoyable time with family and friends, and had safe travel along the way. As we get started here on the eve of December, let's take a quick look at our high frequency data, courtesy of our friends up at First Trust. I've highlighted some areas of note I thought were pretty interesting. You know, if you start from the top and kind of work your way down, obviously the labor market continues to be very strong. We do see chinks in the armor, though. Well, I haven't really seen the latest Challenger layoff survey data. We're hearing from some major employers, some Fortune 500 companies that have announced layoffs here lately. The one that I just read was Lyft, Lyft, the ride-hailing service, announcing a layoff of some measure. Other firms are doing that now, so we're beginning to see the labor market turn just a little bit. But where I have this highlighted here, relative to 2019, obviously the continuing claims number remains very strong relative to the pre-pandemic level. Staffing remains fairly strong. You know, we are seeing some degradation now on the manufacturing side, even though at an aggregate level, manufacturing still remains reasonably good. But you can see here in the relative change versus 2019 that railcar traffic, steel production both down by a reasonable amount. Month over month data looking a little weak as well. And to be expected, given the climate, given the circumstances, kind of given the slowing in demand that we're seeing as a result of high inflation and the increase in interest rates. Hotel occupancy, didn't highlight that, but that's also down. Open table, a relative surprise here. If you look at that number, it's actually up over 2019. And I thought that was really interesting there. TSA checkpoint data has been consistently down. Typically takes business travel a couple of years to kind of pick back up. And as we've no doubt taken note, we have work from home, we have more remote meetings and things like that. So the big worry was business travel was going to be weak for quite some time, but actually the throughput at airports has been relatively strong. We'll see this coming up in a chart which will highlight the inflation factor because at the very bottom there you see global commercial flights. This is the volume of flights is down around 11% relative to 2019. And what happens when you have more ridership at a time where you have less capacity available for those riders, prices tend to go up. And here looking at that TSA data, on the right-hand side, you can see the numbers that are lined up year over year here. Red indicates 2022. 2021, you can see that, again, closing the gap by the end of the year and continuing to close the gap throughout the balance of this year. You see the weakness in 2020, but again, very, very, very close to 2019 levels. Whereas on the left, what will grab your attention very, very quickly is airline fares are going up at an incredible pace. You can talk to a lot of people right now, literally this past week, with travel plans, moving around to see family for the holidays, having to pay a lot more for their ticket prices. Round trip fares are up quite a bit. You can see that this is far outpaced the red line, which is the consumer price index for all items. And you can see that that red line itself, which we know has likely peaked and moving down. Again, we want to continue to see that red line meander down. We know it's going to take some time, but obviously there are components within that, like airfares, that are going up at a pretty strong clip. Retail spending on durable goods. This is one of the things that it becomes a victim when you destroy demand, as you have spending declines on a lot of items. Durable goods are really more the goods that would tend to last more than a few years, right? I mean, and you can see where that's kind of flagged. This is really indicative of, from 2020 on, kind of like the you throw a pebble in the water and you see the ripples and these waves, and the amplitude of the waves goes down as this wave dissipates, right? And so that's kind of what we're seeing now: sharp decline, rather sharp upturn, and now we're seeing things kind of level off, not only in terms of like the rate of gain, but they're actually literally flatlining here, and this is a symptom of what's going on with monetary policy, and I would expect to continue to see this play out like this for a while. And if we're talking about inflation for airfares, there are other parts of the inflation basket that are actually going down, oddly enough. It's not like it was 9 months ago when it seemed like everything was moving in tandem, but here's one thing that really caught my eye, and this is a CPI index for butter. You can see that the year-over-year change is like between 25 and 30%. There's a lot that goes into this, obviously. You got to think, well, where does the butter come from? How is it produced? Where is it produced? Are there weather impacts, feed impacts, heating impacts for winter? And all of this stuff goes into this. And so the input costs basically for butter have gone up, and so prices for butter have gone up accordingly. Now, shifting here briefly, we've got a Goldman investment research piece on the S&P 500, their analysis of what earnings could do in a recession environment. So they have taken peak to trough declines in last 12 months or trailing 12 months S&P 500 earnings during the last 12 recessions dating back to World War II. And you can see, in 2008 was I guess the depths of what could happen in an earnings recession is down 45%. But you can see that, the median is about 13% decline. They forecast about 11% decline if under the scenario that we have a mild recession next year. Now, one thing will be certain: all of the major investment banks, Goldman, Merrill Lynch, Morgan Stanley, are going to be producing their outlooks and their estimates, and I'm going to be kind of scouring those and studying those closely because, right now I think I subscribe to the theory that we are going to have a mild recession. There's indicators, and actually we have a chart, our last chart of the week this week suggests that we have the highest probability, the most anticipated recession in history, in modern history at least. But anyway, in this slide, getting back on track here, median decline during recessions of earnings is about 13%, expected to be within shouting distance of that next year. A little bit busy chart, but I've shown it to you in different ways and different shapes and different colors. This is a chart of the S&P 500 going back into the middle of 2020, which is after the shutdown, and we had that big recovery during the summer led by technology stocks. You can see that that tremendous updraft there, and then a little bit of a retrenchment there in 2021 in the summer. And then we had a 12% rally that lasted through really the end of 2021. And you can see the circle down below at the very bottom of that. We had pretty low volatility and pretty high prices coming off what is being called that Santa rally at the end of 2021. And so, the move upwards from October, basically the fourth quarter move was about 12%. Well, you can see the gyrations after that. You can see a lot of up and down, a lot of material changes. I mean, we have, as I've said many times, this has been one of the hardest years to manage money since 2008. A lot of it is that volatility. You see that realized volatility down below in 2022 has been extraordinarily high. You've had major updrafts of like 10, 12%, and then major downdrafts of like 15%, and then followed by another large updraft. And that's just the nature that we've seen this year. And in fact, just like the Santa rally last year, we were up about 12% in the index so far through roughly the end of November. Again, we got one more month left in this quarter, but just another example of how volatile that we've been in the stock markets this year. And here's crude oil futures on a per barrel basis. What's interesting, and this will be followed up nicely with a slide that will overlay prices and the market prices for energy ETFs. But clearly we've seen kind of a bit of a reversal since the midsummer environment on energy. Now, some of this is due to fears of recession driving lower demand for product. That's definitely an input. There's gyrations over OPEC and their quotas, and are they going to be adhering to quotas, and what's the future of production going to look like? So supply and demand right now is a little bit in flux, a little bit unknown to say the least. Looking into next year, everyone has a forecast, but in the meantime, we're seeing these prices continuously move down. So we take these prices, S&P, GSCI, crude oil prices, year over year down about 0.7%, point to point. But look at that blue line where there is historically a pretty good relationship between crude oil prices and the energy sector ETF, which is dominated by oil producers. Again, energy is not just oil, but in the case of the XLE, it has a lot to do with oil. You think about Exxon, think about think about Chevron, think about Oxy, think about all of these different people. So you see that divergence there, and so what is to be drawn from this really? I think you've got a lot of risk capital that had been kind of sidelined, and I think to some degree still is sidelined, but beginning to try to find the best horses in the stable, and clearly year to date it's been energy, and so there's still a lot of demand for energy related investments, and you can see that manifested here, particularly at a time where it's breaking from the commodity price. Here's a chart of recessions overlaid by the leading economic indicator, the LEI index. And this is a year over year index produced by the Conference Board. It's a fairly good predictor of recessions. And so we see this, the shaded areas represent recessionary periods. This goes back all the way to 1960. And so you see that dotted amber line is the average level of the LEI, or the year-over-year change point, where a recession typically begins. And we're at that point right now. You can see that there's only been one case in the post-war period. That was actually in 1960. You can see there where the LEI did not actually go negative, and it stayed above that amber line, and we still had a recession. But in every other instance where you see it go down about 2% or so, it typically follows, or is followed, or I guess coincidentally followed by a recession, meaning that when that LEI dips to that dotted amber line, that you're at the beginning of recession, and if that holds true, and the predictor has actually been, let me back up. The LEI has had a high predictive capability insofar as recessions are concerned, and so and if you look at that right now, then honestly, we could be on the precipice or maybe at the beginning of a recession now. Here's B of A research with something that I think would be mimicked all across the investment world, is that their outlook for GDP, real GDP, looking into next year. And so obviously we've got one more quarter left in this year, and looking for probably a mild positive, a very mild positive. And I'd say that it's probably not going to be led by the consumer necessarily. It's certainly not going to be led probably by investment. We see that kind of really just kind of moving sideways. It probably is going to be generated a little bit more by trade, perhaps, with the dollar being in a little bit of a decline right now. But anyway, having said that, one more quarter of positive growth, followed by maybe 2 or 3 quarters of negative growth before turning back positive in a non-meaningful way. And this forecast of 2023, really, the first half of the year being negative growth, leading into more positive growth by the end of the year, is very consistent forecast all across the investment world, and consistent with my own thinking too. And then 2024, you get into kind of a benign growth situation. It's not outstanding, but it's not bad either. And I think that's what we're looking at. And again, if you look at this GDP forecast and you get into the mid June, July of next year, and you begin to anticipate that positive growth that comes down the road in 2024, risk capital is going to be starting to look for value opportunities at that point in time, looking for value in the market. It's going to be trying to find a home. So that's why I say we have about another 6 to 8 months maybe of this increased volatility and kind of anxiety, and you're going to have these 10 to 15% moves either way, and we just have to kind of like get ourselves through it. And then, using this chart as a guide, then, and then assume that when we get to the middle of next year, that there's going to be some visibility to that next cycle, that next economic growth cycle, and you're going to want to be a part of it at that time. Here's a quick chart from Goldman Sachs, their estimates for rate hikes, and also their view of a kind of a terminal peak rate in short-term rates. And just like the last chart, very consistent with a lot of firms out there. The current estimate for the peak rate before it goes back down is 5% or 5.1% in short-term rates. And obviously we've got some room to go before we get there yet. And so current guesstimate now is that we get 50 basis points, 0.5% in December. I know a lot of people still expect a 0.5% in February. But in this case, they're expecting maybe 25 basis points in the February, March, and May meetings. There's a lot of people that says we'll go 50-50 and then stop and for a while. And you're getting mixed messages from Federal Reserve voting members too. You've got as many that say that that there might be a case to slow down at some point, as there are ones that say that we're not anywhere close to slowing down. And so you take some of that with a grain of salt, but the longer run rate that the Fed is estimating is about 2.5%. So obviously we're well above that. We have a little bit of ways to go before we reach that kind of like 5-ish% that's estimated out there. And then at some point, then you get that rate rolling over. And it's, as you can see in the far right-hand column here at the end of 2023, the forecast market is pricing at about 4.5%, whereas Goldman here is pricing that to be about 5 to 5.25. And I think rates are going to be sticky when they go up. They may come down. I think the truth probably lies somewhere in the middle there, that rates might be off slightly from their peak, but they're still going to be relatively high, which in some respects, with short-term rates being high, it's good for savers. Not so good for banks necessarily, but definitely good for savers, and provides cash then provides a viable alternative to risky assets where you can actually earn something on it. So now we look at personal savings. We know those numbers have been coming down. This is not a overnight phenomenon. This is something that's been transpiring over a period of quarters, honestly. Left-hand side rate of personal savings as a percent of disposable personal income is going down. Obviously, it was helped during the pandemic with the stimulus checks and whatnot. Those are now clearly in the rearview mirror, and so people are kind of dipping into savings to support their spending habits. And so we're getting down to savings rates like in the 3% level that we haven't seen since 2008. So it's been a long time since we've seen savings rates this low. And obviously this is a kind of a statistic of that comes with diminishing returns the lower you go. And obviously if you spend your savings to the point where you're not saving, that doesn't give you any cushion to continue your spending. And so it's kind of self-defeating in the sense that if your savings rate goes down, at some point your spending will too. And spending and consumption in general is 2/3 to 70% of the economy. So this is all very consistent with this notion that the economy is apt to slow down, and you have to reset itself ahead of a new market cycle. Now you can see the stock of excess savings on the right side, same deal. But again, this is not something that this has been going on for over a year now, where we've seen excess savings come off the sideline to help support consumption. Here's an earnings estimate progression from our friends at Fidelity. Looks at, basically goes back 10 years almost here. And it takes you from the start of the year in through the end of the year. And you can see where these, earnings have generally tracked sideways to maybe a little bit down, very consistent with what we're looking at this year as we've gone throughout the year. Currently, we're looking for about 8.3% positive earnings there in the black. And if you back out energy, that's about 1.2. So obviously, as I mentioned before, energy has been the bell cow this year for returns, and it still is expected to be a meaningful part of the earnings picture this year. Next year, looking at about 2.9% in earnings, and that's below a lot of these other levels that we've seen heading into prior years. But again, it's a tempered outlook. So in some respects, it may be good that we're still looking at a positive earnings performance next year. But again, it's a bit of a moving target. And like I said, there's a lot of uncertainty over the next 6 months about the pace of things. Money supply is the most important chart in this chart pack. And honestly, when you're talking about inflation, it's the most important chart that you can be paying attention to now. This is a rolling 7-month percentage change. And this time series is really important because it goes all the way back to the middle of 1959. Think, the Eisenhower administration. That's how long this goes. But, you can see rolling money supply growth is typically positive to the tune of 3-4%. Now, obviously, we've had bumps and we've had valleys. We've had back in the mid 90s, we had a couple of periods where money supply growth was actually slightly negative, and now it's meaningfully so, negative 1.5% over 7 months. And so, and that's coming off this real peak 20% money growth that is at the heart of inflation. This is why we have the inflation that we do. Stimulus payments and everything else, money supply with the velocity of money factor, which I will not go into, but it is created all this inflation. And now when you pull that punch bowl away and you actually go negative, you're taking money out, you're sucking the lifeblood out of the what is feedstock for inflation. I mean, you can't have inflation if you're taking the money away that's trying to chase these fixed supply of goods. And so, the longer that this stays negative, the longer it stays down, the more hope that I have that the Federal Reserve will kind of maybe tap the brakes on their rate program, and let the economy work for a little bit, because this slow money supply growth will eventually filter its way into the economy, and you will see the demand destruction. You will see, what is intended out of these rate hikes, but you're going to get it from money supply, not rate hikes. Here's our dollar. As I mentioned earlier, the dollar has kind of taken a breather, and we have seen here recently a fairly strong move in the dollar that we haven't seen since 2008. I mean, this is a pretty profound move, and obviously we've had a dynamic increase from the beginning of 2021 in the dollar, and it's put a lot of strain on foreign central banks having to defend their own currencies. So, as we see here, this, drop from kind of a peak of about, 115 on the Dixie, the DXY down to about 106. So that's, about 10 on one. So it's not quite 10%, but it's a meaningful drop. And, you just don't see moves in the dollar like this every day. Here's our 30-year Treasury rate minus the 1-month Treasury rate. And I've shown this chart to you before. Again, this is something that also has a reasonable amount of predictive power in terms of foreshadowing recession. And so we went negative. So this is basically the entire yield curve is now inverted. And that is almost a 100% successful predictor of future recessions here. Now, we're not negative by a large degree, but we are inverted. So it's important to take stock of that. Here's our home price index as we see this continue to move higher and then kind of fishhook here a little bit at the end. So, I think people in some areas, certainly if you're trying to sell a home, you're frustrated at the price erosion, but you got to take it all in the context, and put it, you have to take it all and put it all in perspective, basically, that, that little increase or that big increase that you feel in the market right now is actually relatively small to the move upward that we've seen. If you look at, not only post global financial crisis, I mean, we had a meaningful reset in home prices, meaningful reset over like 5 years. And then we've had kind of a resumption in that trend line of price growth, and it's just flat accelerated in 2020 at a pace which we all knew was unsustainable. And so that's where we are now. Home price index clearly witnessing that fish hook there, moving down a little bit, and likely to continue to move a little bit further down. Container volumes, and now we talk about container shipping, the pricing environment, and that continues to. I mean, we're down 70% on container ship pricing, but in terms of volumes and where you can glean hope for the soft landing is in several different areas, and this is actually one of those areas. And is if you look at maybe the dollar beginning to weaken a little bit again, if you're from the perspective of a foreign company or foreign government that's importing goods, you want to see your dollar or your currency appreciate relative to the dollar. And that's a little bit of what's happening here over the last handful of months with the dollar kind of reversing course. But you see monthly container volumes from the U.S. East Coast over to Europe continues to increase. Now we've got our Richmond Fed data. I try to update you all when I see the various Fed regions report their monthly economic data. So this is just the latest set of data points from the Richmond Fed in Richmond, Virginia. So you can see here the manufacturing index upper left is negative, continues a pattern. New orders negative, that continues the pattern. Fed manufacturing, the capacity utilization is also, that's taken a bit of a leg down, which, when you think about it, if you're reducing your capacity utilization, that is less incentive for you to want to spend. It's less incentive for you to want to increase your capital spending. Certainly not going to be inclined to add new capacity at the time where your existing capacity is underutilized. And you see here number of employees. Now that over the last couple of months has taken a fairly strong leg down, and it's now negative. So to what I was saying earlier about the hiring intentions and some of these perceived layoffs out there by these Fortune 500 companies is actually manifesting itself in this Richmond Fed data. Still on the Richmond Fed, we've got raw material inventories a little bit higher. So this is manufacturing. It's not services, but when you have high inventories, it's usually symptomatic of several things. One, either you're on a buying binge because you have cheap raw material prices and you want to hoard that inventory to help your cost structure, or you have declining demand, which is more at work here. And in some cases, and maybe there's like even a part C to this, and that's, when you have an abundance of or when you have a dearth of inventory, and you're trying to find it wherever you can get it, then oftentimes you get a big reversal, which is also what happened. When things were in short supply with the supply chain issues, you saw a lot of problems there. Not all have corrected themselves, but most have. And so you see here inventory levels pretty high. That's why I don't think that inventory build is going to be much of a support in the fourth quarter GDP number, because overall inventories are relatively high. On the right-hand side, you got prices paid. You see that is rolling over a little bit, but it's still pretty high. So again, it just kind of translates into producer price inflation, the PPI number, and eventually into the consumer sector. That is all rolling down right now. And here we have wages, which have taken a decided leg down. You can see, in a data series that goes back to 2005, this upward sloping trend, and then the relative reversal off of that trend, a trend that really took shape in the aftermath of the global financial crisis. You can see, if you draw a line of best fit, we're clearly below that right now. And wages moving lower is important to the inflation picture. We know that typically happens when hiring intentions go down. So that's essentially where we are at this point with wages. Here's the overlay of leading economic indicators, which we talked about a few slides ago, and the Institute for Supply Manufacturing. When you overlay this data and then make the LEI kind of a 6-month rolling annualized number, you can see that the ISM probably has a little further to go. Again, which would be consistent with our theories of a slowing economy, leading to a mild recession. Here's another look at the LEI from the Conference Board, but it's overlaid with industrial production. So you can see here that in this case too, there's a positive relationship between these two. And this data series goes back to like 1955. But so when you see where the LEI is now, and again, like we saw earlier, it's just slightly negative now. It's a pretty good predictor of recessions. So that's why, one of the reasons why we expect it. But in this case, you can look and see that industrial production is apt to move lower in the wake of lower LEI. This is an interesting chart I came across in some research, actually on the Daily Shot, that share of builders adjusting prices within the month. You can see, you go through, the quarters, and in this case, I believe it is, my goodness, it's actually yearly data, but this is like year-to-date number. You can see that red really jumping out. Basically, builders are negatively adjusting prices throughout the month to a very, very large degree. You have very few builders out there that are actually able to increase price in this market. So here's a chart as we talk about yield curves. We know that the entire yield curve is in inversion right now, but basically this research from B of A Global Investments, that when you see kind of a return to steepening, when rates move higher at the long end, or you get you get this other kind of steepener where short rates begin to roll over, that's usually an indicator that the recession has begun. So again, all the LEI data tends to support this, the fact that we're probably on the edge of this recession right now. The yield curve steepening, it hasn't happened in to a big degree yet, but we have seen it over the last week or so. That this seems to corroborate this to some degree. And here we have in our last chart of the week, we've got what I foreshadowed a few slides ago is the probability of recession over the coming 12 months. And these are professional forecasters. And again, it's not a majority of them, but typically, and you can see these shaded areas represent the actual recessions that were at the subject of all of these predictions. And you can see that, when you get up to about 35%, typically it's pretty much a surety. Even if you get to 20 to 25%, there's a reasonable likelihood that it's going to happen. But lately we've punched all the way to 45%. So as I mentioned before, this is absolutely the most anticipated recession that we've seen in at least since kind of the Vietnam War era. That's all we've got today. Hope you've enjoyed the presentation. Hope you have a great start to your week, and look forward to talking to you. Take care, and we'll talk to you again soon.